Hey everyone, and welcome back. Something I haven't done on the channel in a very long time is a full breakdown, stock analysis, deep dive, whatever you want to call it, on a real company that I am personally looking to invest in. And I think these videos can be very, very valuable in showing you the process that I go through to analyze businesses. And the process that I use is very, very similar for any type of business that I'm looking to invest in. So you can follow along in today's video. And even if you're not interested in investing in Google as a business, you can see the process that I go through and then apply that process to any business that you want to invest in. And that is ultimately my goal here. I want to empower you and provide you with the information necessary in order to go out and analyze businesses for yourself. So while these videos can be complementary to your own research, if you are looking into Google, I highly recommend that you use these videos as an example so that you can apply the process yourself rather than a replacement for your own research. Now, of course, with that said, today we are taking a look at Alphabet Incorporated, more commonly known as their major business, which is Google. And this analysis will follow the same structure of all of the analyses that I do on any public business. First, we start by developing our understanding of the business, looking at its competition, how it generates money, the industry, some of the risk factors associated with it. The second section we look at is competitive advantages, because all of the businesses that we invest in need to have some kind of long-term distinct advantage, something that's drawing customers and clients back to that business so that we can be confident the business is going to thrive over the long term and still be a very large and prominent business in that industry in 10 years' time. The third section we look at is in terms of management, and the reason why we look at management is because these are the people who are making decisions within the business on our behalf. We're owners, we're not managers. We have a management team in place, and we need to make sure that they are doing a good job and that they are trustworthy. And then the final section, of course, is once we've done all of that, we can start to assess what is an appropriate price to pay. And when I say what is an appropriate price to pay, what I really mean is, can we figure out the future cash flows of this business? What reasonably is this business likely going to produce in terms of profit, and compare that to the price today, and whether that relationship is good enough depends on the return that we are targeting. So that is everything that we're going to get into in today's video. So sit back, relax, and if you do enjoy today's video, I would very much appreciate it if you could leave a like on the video, and then I'd love to hear your thoughts down in the comment section below. As always, I'll be answering questions and answering comments as this video goes live. But with that said, let's jump into the video. Now, before we get into talking about Google's business specifically, I just want to start by giving an overview of what we're trying to achieve here. And really, when it comes down to it, when we're analyzing a business, we're trying to answer two key questions and get the answers and reach a conclusion on two topics. The first is whether the business is one that is sustainable and will be thriving over the long term, 10 years and beyond. And the second question is, what's an appropriate price to pay? Because at the end of the day, it can be a fantastic business, but if you overpay for that business and you get a bad relationship between the price you pay and then the profits, the cash that that business actually delivers to you, then it's not a worthy investment. You can have a great business that is not a great investment. I actually have a video covering that topic specifically with a key example where you could have massively overpaid for a business and been negative on your returns for 13 years. Go check it out. I'll leave it linked down in the description below. But with that said, we can get into the first section of our analysis for Google, which is to develop our understanding of the business. Now, Alphabet Incorporated is the public company that you're investing in, and their business is split up into two segments, one being Google, which is the vast majority of their business, and we'll talk about that in just a second. And then 0.4% of their revenue is generated from a segment they call Other Bets. And these are basically a group of very, very small businesses. Some of them don't even produce revenue at the moment. And these are highly speculative investments that may become larger businesses in the future. They have many of these smaller businesses that they put into this category called Other Bets. Some of the more prominent ones include Waymo, Access, and Capital G. And As I said, these businesses may produce something significant to Alphabet's overall business in the future, but at the current time, they are just highly speculative investments. And it would be a very bad idea to try and project that Waymo, for example, is going to be 20% of Google's business in 10 years' time. I think it would be a bad idea to assume that their speculative investments are going to be successful, or at least one of them is going to be successful, because even though I think that may be the case, in the same way as you as an investor, you shouldn't be picking and betting on speculative investments with the assumption that they are going to be successful in the future. So for the purpose of this analysis, whenever we have a business that has speculative investments, I kind of just leave that to be kind of the cherry on the cake. If Waymo ends up being really, really successful and adds significantly to their business, then that's great, but I'm going to be assuming that does not happen for our analysis today. So as I mentioned, the other bets is only 0.4% of their revenue, or it was 0.4%, I should say, in 2019. So the vast majority of their business is their Google business, which is a collection of products and services which collectively have the aim of increasing the accessibility and affordability of information. That's kind of the mission statement of Google, and all of the products and services that they offer, some of them paid, some of them free, they lean towards achieving that goal in some way. So we can take a look at Google's revenue breakdowns, just the Google segment, which is 99.6% of Alphabet's business. So really we're looking at Alphabet, but Google's breakdown in terms of revenue in 2019, you can see that the majority of their revenue generated was from advertising. You can see that search advertising was by far the biggest piece, followed by ads on network member properties, and then ads from YouTube. And then we have other Google, which I'll talk about in just a second, and Google Cloud. Now, I think most people understand how ads on YouTube and how ads on search work, but network properties is something that you may not understand. Well, basically, if you just have any random website, you can become a partner with Google and put banner advertisements on your website. And in a similar way to when I have a YouTube video, I don't partner with the advertiser specifically. I just partner with Google. Google finds the advertiser and puts the ad on my video, and then I get a split of the revenue. And that is the same case for people who run a blog or some other kind of website that has Google ads running on it. And the other thing to mention here is that that other segment is actually quite substantial, and it includes a number of different things. It includes in-app purchases and app purchases on the Google Play Store in their Android operating system. It includes physical hardware products such as their phones and tablets that they're selling. And it also includes YouTube non-advertising revenue, things like YouTube TV and YouTube Premium. It's also important to look at the industry when trying to understand the business that you're looking at. And Google, in this case, operates in the online advertising space. And the current characteristics for the industry are very, very favorable for a business in Google's position, where they are the largest player in the online space. So before we talk about the online advertising space, we can look at advertising broadly, all kinds of advertising. And even that market has been growing substantially in the past and is likely going to continue to grow at a substantial rate in the future. Over the past decade, the global advertising spend, so the total amount of money spent on advertising, has grown at a compounded annual growth rate of 4.2%. And you might think that's pretty small, but in terms of looking at a huge industry overall, it's actually quite a substantial rate. And typically you would see an industry that's really large, such as the beverage industry, for example, or the travel industry broadly. Those industries will be growing at something like 2 or 3% per year. So 4.2% compounded is pretty substantial. But not only does Google operate in the advertising space, they are an online advertiser, which is seeing a substantial increase in growth in terms of advertising spend, much higher than the industry average. What has been happening over the past few years is that businesses are realizing that online advertising is far more effective in terms of the cost to serve an ad in front of a number of people, but not only the cost to serve an ad to 1,000 people, for example, compared to a television ad, so doing that on Google versus television, but also the fact that when you're serving an ad to 1,000 people on Google, it is far more targeted than you could possibly ever get from a television commercial or any other kind of traditional media. And as a result, all different types of online advertising, such as social media or search ads and all of these different types of ads, they are all seeing substantial growth as money is being moved from traditional advertising means into the online space. So as you can see, display ads are expected to grow at 8.6% in 2020. Online video, which Google would also benefit from through YouTube, is expected to grow at 14.6% in 2020. And the only category within online advertising that is growing faster is social media, which of course would mostly benefit Facebook. But you can see that all different types of online advertisements are growing at a substantial rate, and Google is in a prime position to benefit from that. And when you see how dramatic the difference in cost is for businesses to advertise online versus on cable television, for example, there is no surprise as to why businesses like Google are doing so well. So according to Statista, advertisers pay an average CPM, which is cost per 1,000 people reached, of $17.50 for cable television ads, which are paid upfront in the 2018-2019 season. For national broadcast advertisers, the CPM was close to $32. Now, obviously, it's very hard to get data broadly across a number of different advertising businesses, a number of different cable stations, but we could take an estimate that, okay, we're talking about a cost to advertisers of somewhere between $15 and $30 per 1,000 people reached. So how does $15 to $30 for a business to pay to reach 1,000 people, how does that compare to something like Facebook or Google? In Q1 of 2018, Google Display Network ads cost advertisers a CPM of just $2.80. And on top of that, advertisers do not need to pay upfront for Google ads, right? When you're advertising on cable, you pay upfront for a bundle of ads that may last a number of months, maybe the entire year. But when you're advertising on Google, you can just turn on your ads one day and turn them off the next day if you want. And that's not going to affect the price that you're paying for those ads. You're still bidding for them each time that the business is trying to run an ad. So you're talking about a cost to advertise that may be 5 to 10 times cheaper on Google. And as I mentioned earlier, not only is it cheaper, but you're accessing a more targeted audience, an audience that is actually searching for the product that you have to offer, rather than trying to serve your ad to someone who's just watching a television show. And the final thing that I want to talk about for the understanding the business section of this analysis is risk factors. And when you're analyzing a business, you should be assessing every single risk factor. Read through all of them, make sure you understand them. They're in the annual report for businesses. They're usually a couple of pages long. Just read through it and make sure you understand all of them. Now, of course, we're not going to go through all of Google's risk factors, but I want to talk about one that I think is the most concerning at the current time, and that is the risk of government regulation. Google is currently being sued by the US government for breaching antitrust laws, and these laws are incredibly vague. They basically mean that the US government, when they're suing Google, is going to come up with a case to suggest that Google is engaging in anti-competitive practices that stifle competition, actively trying to maintain their monopolistic position in the market. So that is what this case is going to be about, and it is incredibly concerning for Google shareholders, I think, because if the US government is successful, not only could Google receive fines and be forced to change their business practices, but they may even be forced by the courts to break up significant parts of their business. And this case will likely go for well over a year, so we kind of need to sit back and wait and see what's happening. But this risk factor, like all of the other risk factors associated with an investment in Google or any other business that you're looking at, you need to sit down and think about whether you're comfortable with that risk, whether you're okay if that ends up happening and you end up losing money on that investment because that was one of the risks associated with it. It's something a lot of investors do not do. They just look at the upside. They look at the potential. Ooh, Tesla could be the biggest automaker in the world, but they don't look at the downside, the risks associated, and really think about them and whether you're comfortable with that, because you need to be comfortable with the idea that some of those risk factors may come true and will likely come true for some of your investments over your lifetime. and on those investments, you may end up losing some money. So with that said, we can move into the second section of our analysis, which is the competitive advantage section. So this is where we need to identify a distinct advantage that this business has so that we are confident that it's going to be thriving and still a large business in that industry, not only just next year or the year after, but 10 years and beyond down the road. And the way I like to look at competitive advantages is by first coming up with a qualitative analysis. So looking to the business and coming up with an opinion, a hypothesis about what the advantage might be, and then jumping into the numbers to see if it's supported in the numbers. Because at the end of the day, no matter what you think about the business, if they do have an advantage, it will be shown in the strong growth of the business consistently over many, many years. So let's start with that qualitative mode analysis. And I think the key qualitative mode that I can identify, or qualitative competitive advantage, I should say, is a networking effect. Now, a networking effect is basically a situation where a product or service becomes better and more valuable to users the more users that come on. And that process kind of creates a flywheel effect that ultimately ends in a winner-takes-all market. So a primary example of this is YouTube, right? When YouTube got started, there wasn't many videos on the site, and the value for users to jump on and watch videos was very, very low. And at the same time, there was also very, very little value in creating content because there wasn't many people watching content on YouTube. But over time, slowly and surely, more videos were put on the site, which made it better for users to watch, which attracted more users. And because more users were attracted, there was more views being achieved on videos. There was more people wanting to create content. And that creates a positive feedback loop. So if you ever put a microphone near a speaker and it kind of starts off like really soft and then it gets really, really loud and then it's just a screech, well, it's a positive feedback loop. It's feeding into itself. The speaker is feeding into the microphone, which is feeding into the speaker, back into the microphone. And that is what happens with a number of Google's products, not only YouTube, but also search. So that is my qualitative analysis of Google's business. But as I said, it's not enough for me just to look to the business and come up with a guess about what the advantage might be. We need to see that it is supported in strong and consistent growth over time. And in Google's case, they have achieved very strong and consistent growth over time. You can see that over the past 10 years, their growth in their sales, earnings per share, equity, and cash flow for owners has been anywhere between 16 and 21%, which is terrific. And then over time, over shorter periods, growth has slowed down, which is to be expected, but it has remained very, very consistent and is still very, very strong, with cash flow growth up there above 20% in the last year and sales growth also very close to 20%. And basically, when you can identify a distinct advantage in the business and you look to the numbers, the core growth of the business, and you see that, yeah, actually, clients of Google are spending more and more money every single year on advertising because they do have something unique, then you can reach the conclusion that they do have a competitive advantage, and you can be confident that this business is going to be one that's around for a very, very long time. Now, this video has gone on for far longer than I anticipated, so I'm actually going to break down this analysis into two different videos. The second video will be coming out in a couple of days, so don't worry, it'll be coming out soon, and it may already be out if you're watching this a couple of days after it went live, so head over to my channel and check it out if that is the case. But we will be covering the management section of analysis and the intrinsic value section, where we come up with an appropriate price to pay for Google stock in the next video. But I hope you enjoyed today's video, and as I said at the start, if you did, let me know by leaving a like on the video, hitting subscribe if you want to see more content like this, and then head down to the comment section and let me know your thoughts, and I'll be down answering questions and comments as this video goes live. But with that said, I'll see you in part 2 in a couple of days.